Well, today we've got a recognized authority in the industry here to talk to us about after-tax duration. We have Andy Kalotay of Kalotay and Associates. Andy, thank you for being here.
It's a pleasure. Thank you.
What do taxes have to do with duration on tax-free bonds?
Well, let me turn your question around a little bit. It's not so much after-tax duration as duration, which happens to be affected in the case of municipal bonds by taxes. So it's simply interest rate sensitivity. What happens to the value of a municipal bond? And the impact is not only interest rates, but also taxes. And that happens only in the case of discounts, basically. So the basic problem is that when a municipal bond, when the price declines below par, the buyer is going to be liable for taxes on the resulting gain at maturity. And currently, the applicable tax rate is in the neighborhood of 43%. So those taxes depress the price of the bond. So in short, when rates go higher, there's double whammy. The price of the bond declines because rates have gone higher. But once the price declines, there are additional taxes, and that depresses the price further.
So if I understand you correctly, the after-tax duration would take into account not the holder's tax basis, but be concerned with the applicable tax rate being that of the potential buyer.
That's absolutely correct. So the price is set by the market. The holder's tax rate is irrelevant in this case.
If I'm a portfolio manager and I've got bonds that are now at a discount, why should I sell them at all if I'm going to have to compensate someone for the tax liability? Why don't I just hold them to maturity?
In fact, selling these discount bonds is very hard. Whether or not you sell depends heavily on where you bought these bonds. If you bought the bonds at a premium, you are probably better off hanging on to the bonds than selling them, because if you hold the bonds, you are not going to be liable for these taxes.
Yes.
While if you sell it, the buyer is going to be liable. So there's this dichotomy between the hold value on the one hand that you don't observe. The hold value depends on when you bought the bond and how much you paid for it versus what the marginal investor is willing to pay.
Now, can you give me a sense of just the magnitude of this, say with a 15-year bond that is near the cusp there, the de minimis threshold?
I will give you a sense of the interest rate sensitivity of the bond,
exactly.
Specifically, not so much the effect on the actual price. So once let me talk about the 10-year bond. I am more comfortable with the 10-year maturity. So if you calculate the interest rate sensitivity as measured by standard duration of a treasury bond or a corporate bond, where taxes do not play a major impact, the duration, precisely the effective duration, is roughly 8.5 to 9 years under current market conditions. What that means is that if interest rates increase 100 basis points, the price of the bond declines roughly 9%. If it was trading at 100, it will drop to roughly 91. In contrast, when you look at a municipal bond, the effect is much more pronounced. So the duration, the effective duration, the interest rate sensitivity of a 10-year muni, which is trading at a discount, is closer to 13 or 14 years. So a 1% increase of interest rates would result in a 13% decline of the market price.
So that's very counterintuitive for someone who's grown up thinking of duration being the weighted average of cash flows, to have a 10-year bond with a duration of 13.
Absolutely. So what we're measuring here, we call it duration, we call it effective duration, but it is interest rate sensitivity. What people are used to, many people think of duration as a measure of the discounted average life of the bonds. The effective duration and the discounted average life can be very different. In the case of a muni, my recommendation would be to measure the discounted average life by looking at the after-tax yield of the bond at the given price, and then just to apply the standard duration calculation.
Now, what you're essentially saying is most metrics that we use today are inaccurate.
Well, it depends what you are trying to measure. If you're trying to measure something like the average life, then effective duration is not the right tool. If you're looking at interest rate sensitivity, then modified duration or Macaulay duration are not the right tools.
Well, given that, is there any evidence that the markets actually behave this way?
The question is, do the prices of discount bonds reflect the effect of taxes to
Yes.
be paid by the buyer?
Yes.
Well, there's a pretty extensive study. It was published in the Journal of Finance in 2010 by Ang, Bonzali, and somebody else. They have looked at EMA prices, actual trades in the previous 4 or 5 years, and they concluded that not only do the traded prices reflect the effect of taxes, but those prices are actually lower than what would be expected based solely on taxes. And they attribute this to the fact that retail would not want to buy discount bonds because they are worried about forgetting to pay taxes at maturity and having
So
the
they're
IRS
just
come after
scared
them.
of them.
They are scared of them, yes.
Okay. What about just this past year? We had quite a move in interest rates with the talk of tapering. Was there any evidence that discount bonds did exactly what you said?
Well, in last year, the major increase of interest rates occurred, I believe, in May and June. And what happened was that, indeed, what I described is exactly what occurred, and that there were several articles in the Bond Buyer indicating that the par bonds declined in terms of price much more than would have been predicted based solely on the increase of rates of premium bonds, increase of yields
Yes.
of premium bonds.
If I'm a portfolio manager and I'm measured against an index, and how could I incorporate this? Most of the index statistics are not going to have after-tax duration. So even if I adopt it as a portfolio manager, I may be looking at an index that all I have is a pre-tax duration on.
Well, you have the tools to calculate the after-tax duration of the index.
If you have the constituents.
If you have the constituents, and I assume you could request that, or you could perhaps do it on your own. But it is a factor that has to be considered. Currently, the impact may not be too significant because only about 15% of the bonds are selling below par. But if rates go marginally higher and the price and the percentage of bonds selling at a discount increases, this will be a major effect. And it is absolutely mandatory for fund managers who try to match an index to know what the effective duration of that index is.
It would be, yes. Now, this is a somewhat difficult concept to get across. How would you suggest communicating the concept to either a board or clients or an investment committee who understands duration because it's a traditional metric, but scratch their head when you start talking about taxes and duration together.
Well, it has to be presented in the context of expected performance and marking to market. That's where the rubber meets the road in this case. And essentially, the board needs to understand that if rates move in a certain way, there's going to be a certain impact on the mark to market value of the portfolio. And in particular, if rates move higher, the decline of market value is going to be quite a bit larger than what you would expect based purely on standard calculations that disregard the effect of taxes.
Okay. If I want to know more about this, where would I go?
Well, there are several articles. People have been aware of this, the impact of increasing rates on the prices of municipal bonds for a very, very long time. And I could mention articles written back in the late 70s and early 80s prior to the existence of the current rigorous theoretical valuation of bonds. I am personally aware of a very nice paper written by Marta Leibovitz in 1979. More recently, what I have tried to do was to make this analysis more formal. So I have published I have an article forthcoming in the next issue of the Journal of Investment Management on this very topic, the interest rate sensitivity of municipal bonds. It's essentially applying pretty standard option-adjusted spread analysis, but including the effect of taxes.
What about your website? Is there information on your website that one might go to?
Well, there are some articles under research on our website, that can be downloaded, and also we have a calculator for municipal bonds on our website, and it's open to the public, and people can put in their own price information and see the effect of the different prices on duration. And if the price happens to be under 100, they will see that there's a significant difference between pre-tax duration and, let's call it after-tax, the actual duration.
So is that www.kalotay.com?
Yes, www.kalotay.com, and right on the home page, go to calculators.
Very good. Thank you. Thank you, Andy.